Hey everyone, Couch Investor back to another video for today. So let's talk about the four stocks, four companies that are worth your while in the month of July. Of course, there are many other companies that you could put on this watch list or on this buy list. If you have more companies that are worth our while, do let me know down in the comments below. And if one of the four companies that I mentioned throughout this video is in your portfolio, let me know down in the comments as well. First of all, huge congratulations to Tesla and all Tesla shareholders on another record quarter. Congratulations there. Now, first company I want to talk about is also something with cars, but it's not a car maker. It's actually Uber. So let's have a quick overview of the current state of the company. Now, performance-wise, this year it's done quite well. 75%. Then since last year, 111% there. Very, very nice. If we look at valuation at the PE for the next 12 months, 35.9 times. Now you might say this is extremely high, but this company is growing at a nice pace. So sales-wise for fiscal year 2023, according to analyst estimates, they expect growth of close to 18%. Then for 2024, close to 17%. And then 2025, closer to 15.5%. Now, as for EPS, or earnings per share, fiscal year 2024, we can see here a 56.6% growth. And then for fiscal year 2025, 37% growth there year over year. So quite nice. And these valuation metrics here are quite reasonable. Now, if you invested in Uber when it went public, you would only be up 1.4%. So the performance there has not been optimal. Of course, in between you had pandemics, etc., and profitability was a huge issue. Right now, actually in the last 2-3 quarters, we are seeing positive momentum when it comes to profitability and especially when it comes to cash flow as well. Now, here's a quick overview from last quarter. So monthly active platform consumer grew 13% year over year, trips increased 24%, gross booking increased 19%, revenue 29%, loss from operation improved by 46% there. Adjusted EBITDA improved 343%. Free cash flow went from negative to now positive $549 million. Now, as for the outlook, they expect gross booking between $33 and $34 billion for Q2 and adjusted EBITDA of between $800 to $850 million. Now, of course, we have to look at what happens in mobility, delivery, and freight. So mobility gross bookings there increased 40% year over year, delivery just 8%, and freight decreased 23%. Now, as for revenue, same thing there. Mobility takes the largest chunk, 72% increase year over year, delivery 23%, and freight down 23%. Of course, as with the last 2 quarters, I believe we've got this benefit from the business model changes in the UK. Now, with regards to subscription, advertising, and maybe some more margin expansion, we've got some news here with regards to membership. So Uber One. So they returned to the Super Bowl stage for the 3rd year to launch our latest campaign, One Hit for Uber One. Uber One continued to experience ongoing adoption, and our member base in the United States and Canada reached an all-time high. And they did say during the earnings call that Uber One members spent 4 times more than non-members. Retention is 15% higher than non-members as well. And Uber One continues to be a higher and higher percentage of our bookings. Now, when it comes to advertising, they say here that active advertising merchants during the quarter exceeded 345,000. And during the earnings call, they added a little detail here. So advertisers are up 70% year over year using the platform. Now, they did also say that the mobility business sends them more customers than they get from Facebook and Google and Snap and all of these different platforms combined. And that's just a structural advantage that they have against the overall market, certainly against their competitors. And last thing I want to mention here, cloud migration. So they announced long-term partnerships with Google Cloud and Oracle to migrate their infrastructure to the cloud. These strategic partnerships include other areas of collaboration with Google and Oracle, because I do think that before they've done everything in-house, which obviously maybe cost them a bit too much. So that was company number 1. Now, before we go to company number 2, if you're enjoying this type of videos, leave it a thumbs up, subscribe. If you have not, would really appreciate that. We're on our way to reach 30,000 subscribers by the end of the year. So we really appreciate it if you hit that subscribe button. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, company number 2 is Crocs. Yes, Crocs. You've heard it right. So a quick overview at how Crocs has been performing lately. So year to date is just up 3.7%, but since last year's 1 year ago performance, 131%. So quite nice there. Now in the last 3 years, if you bought it back in 2020, you would be up close to 4%. Of course, you could have been flat-ish last year in the summer. But overall, valuation-wise, PE last 12 months, 11.4 times, next 12 months, 9.5 times. If you look at EV to sales at 2.5, 2.3 times, not that expensive in my opinion. Analyst estimates, when you look at growth here for sales, they expect fiscal year 2023 to grow 13%, 24, 9.3%, and then 25, 9% as well. When we look at earnings per share, we see some growth here between 5 to 12% in the next 3 years. Now, of course, I know some of you might say, oh, this is just a hype that started during the pandemic and it will probably die down soon. Maybe that could happen, but looking at the numbers that you're going to see in a second, that hype might continue for a while now. And as that continues, as the business grows, they become a bit more profitable as well, the stock should reflect that. And of course, if you look at the graph, yet again, the stock has reflected that, especially since the lows at around $45 or so. So Q1 highlights: revenue increased 36% year over year. Gross margin increased 470 basis points, adjusted gross margin 30 basis points there. If you look at operating margin, that's up 860 basis points, adjusted operating margin up 130 basis points. So again, quite a nice performance there year over year. Diluted earnings per share up 101% and adjusted diluted earnings per share up 27%. Now, of course, revenue can be cut into a couple of parts here. So Crocs Inc., so as a whole, $884 million. Then you have the Crocs brand, right? What you see right here. That grew 19% year over year to $649 million. And then you have Hey Dude brand, which is company that they bought not so long ago, that increased 106% year over year to $235 million. Yes, that should increase the growth rates overall, but it will hit the bottom line a bit at first. Now, as for guidance for Q2, they expect revenue to grow between 6 to 9%, adjusted operating margin to be 26%, and adjusted diluted earnings per share 2.83 to close to $3. Now, for fiscal year 2023, they expect revenue to grow between 11 and 14% overall. Crocs revenue to grow between 7 and 9%, and then Hey Dude, as I said, that's going to grow much faster in the mid 20% there. Adjusted operating margin between 26 and 27%, and adjusted diluted earnings per share, basically $11.50 at the midpoint. Now, they do talk here about deleveraging, so the gross debt to adjusted EBITDA outlook, they went from 3.1 times to now mid-year 2023 estimates, a bit lower than 2 times. The long-term target is between 1 to 1.5 times net leverage, so they're well on their way to reach that target. And I know Crocs might not be the appealing company to all of you. It's not a high-tech growth company, but it is a company that is growing quite nicely, and it has outperformed a lot of companies in the last couple of years. And now company number 3, you might be more familiar with that, especially on this channel, and it's a fintech company. It's a supposedly high growth company as well. It's Block, ticker symbol SQ. Yes, it's the one where Jack Dorsey is still CEO. So this is the current state of the company. Of course, the performance there for the stock this year to date, is only up 6%. Since last year, it's only up 8.3%. But if you look at valuation, and especially the expected growth rates there, it becomes extremely appealing, especially at these prices here, which has been the same price for the last couple of quarters now, $66 for one share. So according to analysts, the expected growth here for fiscal year 2023 when it comes to revenue, 18% year over year, earnings per share, 70% growth there. Fiscal year 2024, you have 38% growth for EPS and 13% growth for sales. For fiscal year 2025, we're at 14% growth for sales and 34% growth for EPS. So again, for profitability standpoint, this company should be growing quite fast in the next 2 to 3 years. And of course, if you remember, we're still growing quite nicely, especially when you look at gross profit that increased 32% year over year to $1.71 billion. Cash App gross profit, 49% growth year over year. Square gross profit, 16% year over year growth. And yes, this was still my issue. So operating income, this is still a loss of just $6 million there. Adjusted operating income 51%, but as you can see, we can't really rely on these type of movements here for future projections right now. And the same here for net income. In this case, it was still a loss of $17 million. I would say once we're going to see a clear path toward more profitability, then the stock should be flying high. Now, they did announce a couple of new things lately. So Square unveiled Square Credit Card and new cash flow management products in beta as banking adoption grows. Now, they say here both Square Credit Card and the new loan options are currently in beta, but have seen strong usage already, including among upmarket sellers. Since these products entered beta, 25% of credit card spend and 30% of originations from loans with fixed monthly payments have come from upmarket sellers. And then they say through the first 5 months of 2023, sellers using Square Checking spent more than $1 billion using their debit cards, a 20% increase when compared to the same period last year. Now, with regards to that credit card, they say, of course, there's no fees. So there are no fees with the Square credit card, no late fees, no annual fees, no foreign transaction fees, no other fees. But what happens when you miss a payment? Well, if you miss a monthly minimum, a small percent of your daily card sales will be deducted until your minimum payment amount is met. So while there might not be any fees, there still are some fees if you miss a payment. Now, I'm still going to repeat myself over and over again when it comes to Jack Dorsey and him being the CEO of Block. I just don't think he is the right CEO to lead this company into the future. I think he's good for maybe side projects like crypto stuff. Maybe that will happen sooner rather than later. Fingers crossed. And then company number 4, this is my second largest position in my portfolio. It has been performing quite nicely this year. You've heard me talk about this company a lot on this channel, but I still think that we can see a lot of growth ahead of it. And it's Amazon. So Amazon has been doing quite nice year to date, 55% they're up. Then since last year, 22.74%. Of course, if you look at valuation, it really doesn't make much sense here, right? If you look at the PE ratio, extremely high. But as I keep saying, as they turn the page towards being a more profitable business, you will see these numbers decrease extremely fast in the next coming quarters. Now, when you look at the analyst estimates for fiscal year 2023, I expect 9.15% growth there to over $500 billion. Fiscal year 2024, 11% growth. And then fiscal year 25, same thing there. But look what happens with EPS estimates. So fiscal year 2024, 65% growth there. And then in 2025, another 43.4% growth there. So as I said, as this company becomes more and more profitable, you suddenly will see the multiple compress at an extremely fast rate. Now with Amazon, we've had a couple of announcements, especially when it comes to AWS. Yes, AWS growth has been slowing down lately, but as I keep saying, we're going to see this reaccelerate towards the back half of the year. Right now, they're focusing on making sure that their existing client can continue to grow in these difficult times. They are okay taking a hit when it comes to growth right now, so long as they know that they will grow faster in the future as the market turns. Now, they announced AWS general availability of AWS App Fabric to enhance leading SaaS applications for improved productivity and security, again, making it much easier for the companies to grow with them. So App Fabric, a no-code service that enhances companies' existing investment in software as a service applications with improved security, management, and productivity. With just a few clicks in the AWS Management Console, IT and security teams can use App Fabric to add new capabilities that make their existing SaaS applications and productivity suites work better together. Now, that didn't stop there. They announced a Generative AI Innovation Center, so they will invest $100 million in a new program that connects AWS machine learning and artificial intelligence experts with customers and partners worldwide to accelerate enterprise innovation and success with generative AI. And by the way, if you wanted a major overview of the biggest cloud players out there by industry, their customers, by region, customer size, and key customers, maybe take a screenshot of this. And then last thing I want to talk about with Amazon, so earn extra income with your business. So they announced something new, Amazon Hub Delivery. So earn up to $27,000 per year by partnering with Amazon Hub Delivery to deliver packages to your community. So of course, this has to do with last mile delivery. For Amazon, this makes more sense. You basically partner up with them. They're looking for 2,500 partners to jumpstart this new program. So basically, if you partner up with them, you'll get packages and then you'll do the last mile delivery. For Amazon, this is worth their while, probably going to spend less money on delivering those last mile packages. And then for you as a partner, you can get, well, more income, and you'll probably get a bit more traffic to your stores as well. Now, of course, when I talk about Amazon, I can talk about Amazon for hours and hours. If you want more information, go check the other Amazon videos on this channel. So that will be it for this video. Uber, Crocs, Square Block, and Amazon are the 4 companies I'm watching in the month of July. Which companies are you watching? Or do you own any of these companies? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I'll see you all in the next one. Bye-bye.